Hello, everybody. Can I get a sound check? Sound check. 1, 2, 3. 1, 2, 3. Welcome. Good evening. You guys know I like to start a little early. You know I love sharing pictures. I got Mr. Crab up there. He always holds the pen of the day for me, and I got my pen collection. Some people asked me about my pen collection. They were like, Stu, how many pens do you have? That's just a small sampling. Hello. So first of all, I want to say this. Let me see. Is there any echo on my end? Let me know. Someone said echo. Let me know if there is an echo. Because again, I want to start really nice and early for you guys. So first and foremost, okay, turn up the mic, turn up the volume. Seems like that we're good here. No echo. Okay, awesome. So I hope everyone is doing absolutely fantastic. For those of you, if you have any kind of problems with your audio, volume, stuff like that, reload your screen. Make sure that that everything's going to be nice and crisp for you guys. Also, we have. I see someone saying that the volume is low. Audio is good. So, okay, awesome. So I think that might set it up. If any of you are having any kind of audio or video problems, keep in mind we do record this, okay? Make sure that you are refreshing your page. You're going to 720 on your video quality. Yes, I always am on time. I try to do that. So, yeah, make sure the champagne's on ice for those of you who are going to be taking your test this week. Do we have any first timers here? If there's any first timers here, please just let me know. Because I love saying hello to you guys. We got the Stu crew running tonight. We are going to be doing, yeah, Ben said the $400 pens that I always use in my examples. So in that photo, there's actually some other ones on there that might be a little more expensive. So, hey, any first timers, you're going to have an awesome time with me. We're going to keep rocking and rolling tonight. If you do have any questions, you can pop it up in the chat box, okay? I will try to do my best to answer as many as possible. Here's the whole goal. We're going to get you educated, okay? We're going to have some fun and hopefully clear up a couple of misnomers, a couple of things that are going on. I might not get to everything, and here's the thing. Tag me in a Facebook post in our Facebook group, and I would be more than happy to take care of any of those questions on Friday. We have Facebook Friday coming up, which means, yeah, we have a bunch of first-timers here. So really, guys, I hope you guys have a great time. Again, we're doing financing tonight. So hopefully I clear it up for you guys. So let's, without further ado, get the show on the road. So what I always love to do first is I love going over what a mortgage transaction is, okay? What a mortgage transaction is, because a lot of people find this to be very confusing. So again, bear with me. Keep in mind, you could pause, rewind, and we're going to have this on recording. But here's what happens with a mortgage transaction. So buyers go to a home. That home was like a beautiful home. That was like a Mick mansion, okay? That's a big Mick mansion there. So first-time home buyers. And as some people would say on HGTV, he would probably be a butterfly catcher and she would melt crayons for orphanages, something like that. And their budget would be like $2 million. So what happens is buyer finds a home, and what they do is they go over to the bank and they say this. They say, hey, bank, we need some money to go buy this home. Okay, we love it. We need some money. So bank says to them, yeah, absolutely. We are going to give you a loan. And here's what I'm going to tell you guys, okay? Here's what I'm going to tell you. Repeat after me. The money is not the mortgage, okay? The money is not the mortgage. Everyone in a mortgage, in a mortgage transaction gets this confused. Because what happens is, as real estate agents, okay, what happens is, and also lay people, we always say this: I'm going to get the mortgage. I'm going to get the mortgage, right? I am going to get the mortgage. So what happens is everyone always assumes that the money is the mortgage, and the money is not the mortgage, okay? So the banks and lenders are going to be providing those loans, okay? Those banks and lenders are going to be providing those loans, and banks, lenders, all that makes up what we would refer to as the primary market for financing, okay? So they're going to be the ones that are going to be giving out money. And now, there's many different loan types, and we're going to go into that. So I'm going to clear up for you guys what an FHA loan is, what a VA loan is, what a conventional loan is. Nora, no problem that you're late, and I'm so glad that you said you couldn't miss any of my webinars. Yeah, we always have a fun time in the Stu Crew. So, guys, I'm always a fun guy. I always try to get, see anything in the chat going on, stuff like that. So if you do have any comments, questions, concerns, I will try to get it answered in the chat box. So do put it up in there, and I will try to address that. So Samuel Anderson asked, the mortgage is the collateral. Yeah, we're definitely getting there. So the mortgage, we're going to describe what that is and who gets the mortgage, right? So we kind of use a little bit of slang, getting back to what I was saying. When we say, hey, okay, hey, we're going to get a mortgage. Because what you're actually doing is you're going to get a loan. So again, keep this in mind. The money is not the mortgage. So just like you guys, the Joe Show, he bashes it into your head. Lien money, lien money, lien money. Yes, because a lien, okay, kind of reinforcing that, a lien is a financial encumbrance on a property, okay? A lien is a financial encumbrance on a property. So let's keep moving, let's keep grooving, okay? Borrowers are super duper happy because now they have money to go and buy their home, and they're like, wow, this is amazing, 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 okay? And now here's what happens. Here's the final step, okay? So the bank has lent its money, and now what happens is this, okay? So the bank has lent the money, and now, in exchange for lending that money, okay, in exchange for lending the money, the borrower is going to give the bank the note, also known as the promissory note, okay, and they're going to give the mortgage. So keep in mind this, everyone always, Joe says this all the time, I know Adrian does, okay. What happens is this, the mortgagor, we always say OR gives and EE receives. Joe's little song is probably playing in your head right now. Okay? I don't know all the words to it, but you kind of get the gist of it. So the OR gives, the EE receives. Okay? So what happens is the mortgagor is the borrower. The mortgagor is the borrower. Can't stress it enough. So here's what I'm going to tell you. If there's anything you remember from this webinar, okay? Number one, the test is a hard test, and you got this. Number two, the borrower is the mortgagor. They're giving the mortgage to the bank, okay? Number three, the money is not the mortgage. The money is not the mortgage. And number four, okay, the borrower is also going to be giving the promissory note or the note. So what do you guys know about the note? What is the note? Tell me what that is. So Kyle Sunshine said, so the bank holds the note and the mortgage for giving the money. Bang, bang, boogie. That's basically the whole entire thing. That is the gist of it, okay? So Isabel said, it's an IOU. It's a promise to pay. Absolutely, okay? Evidence of debt, yes, because it is an IOU. So the promissory note is an IOU, okay? Now, what is the mortgage? What is the mortgage, okay? So, because Gail even said it. She said, so what is the mortgage, okay? The mortgage is using the home as collateral if you don't repay that loan. So if you don't pay in accordance to that promise to pay, that IOU, then what happens is that lender, that borrower could then foreclose on your home, okay? Because they're going to be able to put a lien money, okay, on the property, okay? So the mortgage is collateral. Yeah, think of it also like Monopoly too, because follow this. Here's what happens in Monopoly. Right before you just flip over to the whole entire game board and all the pieces fly across the room, what happens is this. You're mortgaging the heck out of all your properties, right? And when you mortgage a property, okay, what happens is you are making that voluntary choice. You are mortgaging it and you're getting money, okay? So Nora Jenkins wrote, Stu, do they get title to the property? Defining they, I assume that you mean the bank. So in a mortgage transaction, and it differs from a trust deed, okay? So what happens is this. The lender would not get title to the property. The legal title would actually be held by the borrower, okay? So the mortgage is that pledge of real property, okay? It's putting that property up as collateral. And another word that we use, fancy pants words, okay? Fancy pants words. When you mortgage a property and pledge real property as collateral for repayment of a loan, that is referred to as hypothecation. That's probably one that you come across a couple of times. Listen to me, I can't even say the words right. Hypothecation, okay? So, yes, this is a little different if you're going to be in different states, whatnot, but for the most part, that's what it usually is. So again, there is some state-specific stuff that I might have gotten into there. So again, take it with a grain of salt. If you're like, Stu, you're wrong. Bottom line is this, and it depends if you're a lien theory or title theory state. And I should have prefaced it with that, because I know some of you guys know that there is some differences, and your state may vary. So I'm going to kind of put that on the back end of it. Like if you're like, Stu, some of this is incorrect. Again, it depends if you're a lien theory or a title theory state. So, okay. So, yeah, because some of the states, the lender will take title to the property. So, again, I should have answered that in a more general sense. And, again, I answered that just off the cuff, and because I wanted to try to get that to you. But I answered with a slightly state-specific question, and now I'm kind of back-ending it with, hey, back that up a little bit. Depends if you're a lien theory or title theory states. Okay? So, okay. Let's keep moving, let's keep grooving. As I do that, someone asked me to repeat hypothecation. So hypothecation is going to be when you pledge real property, okay? When you pledge real property, okay, as collateral for repayment of a loan, okay? So, let's take a look at our different type of loans, okay? So the first type of loan that we're going to refer to is the VA loan, okay? VA loan. So VA loan is for the veterans of the United States of America. Here we go. To qualify, some of you might not know this. To qualify, okay, you have to hit one of the three targets here. You have to have 90 consecutive days of wartime service, okay? And some of you guys are already putting some great comments in the chat box. No down payment needed. Yeah, that's a big benefit. When we get to benefits, I'll talk about that. But let's talk about what you need to qualify, okay? So 90 consecutive days wartime, 181 days of active service during peacetime, okay, and 6 years in the Reserve or National Guard, okay? And also, you must be honorably discharged, okay? You must be honorably discharged, okay? So, let's talk about what the benefits for a VA guaranteed loan is. And here's what I'm going to tell you guys. Make sure that when we're talking about VA loans, let me underline some of the key words here. VA guaranteed, okay? They guarantee the loans, okay? So hello to you guys who are saying hello to me. You know I love you guys. I miss you this weekend. I miss you. I hope you had a great weekend. I hope that you had a fantastic weekend where you actually got some stuff done. Maybe you didn't study too hard, right? Next is some of the benefits. It is an assumable loan. Yeah, bang, bang, boogie, okay? So what happens is the big one here is zero down payment. Now let me tell you a little bit about the why. I'll tell you about about the why for the zero down payment. So Gail asks, though, she interrupts with a great question. She interrupts this daily broadcast. I have heard VA loans are assumable. Is that true? Yes. So some of your instructors might say that there is a little nuance, a little minutia to that. But what I will tell you is, in a general broad stroke of a pen, they are assumable, okay? They are assumable, okay? And someone asks also, does the person assuming need to be a veteran? No. That is definitely, they need to, so here's the thing, they do need to qualify for the loan, like credit-wise, okay? And basically assumable, so someone asked also, what is assumable? Assumable means that they could take over the loan, okay? They could basically take over the payments for that. And assuming is, so someone said this, so you guys love assumable. So what happens with assumable loans, okay, right now, because interest rates are so super duper low, there's really not much of a benefit for someone to assume a loan, because you could get a new loan generated at a really ridiculously low rate. However, if interest rates were to jump, okay, that would be a scenario where, you know, an assumable loan would be really nice, because you would have, let's say someone takes one out now, okay, and what would happen is, if you had an assumable loan at a really nice, attractive interest rate, that might be something that is a benefit, okay? So, yes, assumable, yes, it is going to be zero down payment, and here's the reason why. So I was getting into the why behind the zero down payment before I kind of took a little left turn to answer the assumable question. Zero down payment is because it is a guaranteed loan, okay? And what they will tell you is this, okay? And also, I know you guys are summing to, or also mentioning a couple other things. I'm giving you kind of like the big, like, I'm giving you the broad strokes of the pen on these loans, so that you could get a little bit of talking points, so that when you see some of these things, you could kind of attach these definitions, these meanings to it, right? So when it's guaranteed, basically what happens is the Veteran Affairs, they guarantee the top 25%, okay? Typically the top 25% of the loan, okay, to the lender. So what happens is, that's why the that's why they allow the veteran to have a zero down payment, okay? Jonathan asked a great question, and I have to answer this. What if the person wants to add a down payment? Can they do it? Absolutely. So if you want to put 30% down, 40% down, and still take out a VA loan, absolutely, you certainly can. You know, it is not necessary for you to take advantage of the zero down payment benefit. You don't have to. You could put down, you could still take out a VA loan, and you could get, again, a solid down payment, and, you know, lower your loan to value amount. Michelle said, this is a great group. We are a fantastic group. The Stu Crew is amazing. Like I said, I missed you guys this weekend. I hope you missed me too, because I love doing this. I love coming on here and giving you guys some education. Yeah, so Mike said, oh, Mike, you actually said it better than I was saying it. You said you can, but it's not mandatory. Man, I put a lot of words in there. And Ellen said to me, hey, can you back it up for a second and tell me what you meant by the top 25% of the loan? Sure, so what happens is, it's like having a 25% down payment almost, okay? It's like having a 25% down payment in the eyes of the lender, because that's what the VA is going to be giving to be guaranteeing, because what happens is FHA is going to be an insured loan, okay? The VA guarantees that top 25%, and there's a lot of minutia that goes into it, so I'm painting with a broad stroke of the pen on that one, okay? So some of you guys said Stu Crew's greater than any of theirs. Let me tell you this. Everyone has their own style. Yes, absolutely, 1,000%. And we got a new instructor coming on tomorrow. You are going to absolutely love. She is going to be the bee's knees. I love Cynthia. So you guys are going to have a lot of fun tomorrow. So, but we have to come up with a name for her. So her name is Cynthia. So we have the Stu Crew, the Adrian Nation, the Joe Show. So I need something for Cynthia. So you guys got to help me out with that, because you helped me with the first one, and we kind of threw it all onto everybody. Yeah, she's going to be absolutely awesome. She brings a wealth of knowledge to everything. So I kind of digress a little bit to plug her a little bit. So she's awesome. So here's an FHA loan, okay? FHA loan is insured by the Federal Housing Administration, okay? The Federal Housing Administration, okay? So, does the FHA lend money, okay? Does the FHA lend money? Do they lend money? Ooh, sitting with Cynthia is actually a good one. The FHA insures loans, they don't give loans. Coffee with Cynthia. Ooh, I gotta see what she likes. I gotta... Makes sense with Sin. Ooh, she might have better names than all of us. All right, I might have to up our game. I like some of the things that you're saying here. So yeah, the FHA is going to insure loans. Okay, that's the Federal Housing Administration. Okay, and what are the benefits of an FHA loan? Can you guys tell me what the benefits of the FHA loan? Ooh, SC, Win with Sin. Sin's Win Crew? I don't know if she likes that. We're already abbreviating her name, and I don't know if she likes that. So tomorrow, you guys are gonna have to, really hype her up and see if you guys are gonna see what you think. So what happens is low down payment. Jonathan, don't worry, I'm gonna help you through FHA. That's why we're spending a little time on this. So low down payment, okay. And that low down payment means that there's just going to probably be a higher loan-to-value ratio, right? And also, usually this is something that, this is something that usually some credit-challenged individuals, and I'm, again, painting with a broad stroke of the pen to just give you an idea as to why someone would want to get this, okay? Gretchen put 580 or higher credit, yeah. So, MIP... Okay, you guys probably are asking what that is. That's mortgage insurance premium. Okay? Mortgage insurance premium is the mortgage insurance that a borrower would have to take out. And Kiva, yeah, 3.5 down with FHA. Absolutely. So MIP is mortgage insurance premium. It's like PMI, but of course, this is the real estate exam, and we have to confuse you. So it's MIP. It's mortgage insurance premium. What they do is they pay an upfront cost, and they also pay an annual premium that's going to be split out over the course of the year. Oh, as I'm trying to get my words out. Okay, so that is an FHA loan. Chilling with Cynthia. Yeah, I like some of the names that you guys are coming up with, so there's some really good ones there. Like I said, I want you to give her a warm welcome. So you guys really welcomed me, and I love coming on here with you guys. So I want you guys, look, represent, make her feel really nice, warm, and welcome at home, because this is going to be her new place. She's going to be here with you guys every week. So, like I said, I can't thank you enough for giving me a warm welcome, and really, like I said, being just super awesome every week. So I just want you to make sure you give the same love to her. So let's talk about a conventional loan. So, let's see. So someone asked what MIP was again, and I want to just make this very clear. This is mortgage insurance. Okay, that you would have to pay as the borrower, okay, for the FHA loans, okay, depending on what the loan-to-value ratio is. Yes, there are the dogs. Yeah. It wouldn't be a Stu webinar if the dogs didn't see a leaf or something blow across the window, right? So, let's go to a conventional loan. So, is MIP the same as a PMI? It is very similar. Yes, it is very, very similar. However, the difference between PMI, okay, and MIP is MIP has an upfront component as well. So MIP has an upfront component, okay, and what happens is this. You would have to pay also an annual premium, okay, that is paid out monthly. So they would divide that over 12 months, and you'd be paying that monthly. Now, conventional loan. okay, here's what a conventional loan is, okay? So, Detail Shark, you said MIP has an upfront component. What do you mean by that? So when they close, okay, as soon as they take out the loan, and that's what I mean by upfront, okay? What happens is this. They have to pay something at closing when they take that loan up, and that's what I mean by upfront. So at the beginning of the loan, they would have to pay a component as well as an annual premium. So a couple of you guys are asking me to explain short sale, okay? So what I'm going to do is this. Let me finish up with the LTV conventional loan, and then what I'm going to do is this. I am going to explain short sale and for you a little bit, just kind of touch on that. So a conventional loan, okay? Someone asked, are conventional loans private loans? And here's what happens is people always get this confused. So whenever I ask a student, I say, hey, what is a conventional loan? They'll say, that's a normal loan. And here's what I'm going to tell you. A conventional loan is very simply classified as this. Okay, conventional loan is very simply classified as it is not FHA or VA. Okay, so it is not FHA or VA. So what happens is on a conventional loan, it is not FHA, not a VA loan. So here's the thing with all these loans, FHA, VA, and conventional, okay, FHA, VA, and conventional, they're all gotten at a bank lender. So you could go to a Wells Fargo, you could go to, any kind of bank and get a loan that is either FHA, VA, or conventional, okay? So doesn't change where you get the money from, okay? And all the changes is some of the qualifying aspects of it, some of the minutiae, some of the options that you might have, and what you might qualify for as a borrower, okay? Because it all depends. It all depends, okay? So it all depends on what you qualify for, what you can afford, and what's the best option for you, okay? So just think about it going into, let's say, a pen store. Some of you might like a certain type of pen, some of you might not. Some of you might be able to afford a certain type of pen, some of you might not. So it's the same thing with loans. They all come from the same place as long as they're approved lenders, okay? So most lenders will deal with all of these, okay? So it's no difference in regards to where the money comes from or what happens with it. But it's something that just depends on what's right for you, okay? So I hope that cleared that up for you guys in regards to that. Now I'm going to take a slight detour because you guys did ask me about short sales, and I've never gone over short sales, so I want to just really quickly, since we've done all of the loans, right, I want to talk about what a short sale is. So let's say I bought my home for $100,000, and we're going to use even numbers, okay? And I bought it in 2015, okay? And now let's say for whatever reason, okay, and let's also do this. So I bought it for $100,000, and I took out a loan of, let's say, $95,000, okay? Now, if for whatever reason in 2020, okay, the home is now worth, okay, only $80,000. Oh no, guys, this is not good. So in 2020, it is worth $80,000, and that is definitely a sad face. So now, what happens is this: you can't just do this one thing. You can't just sell it for $80,000 and think that they're going to forgive the loan amount that you owe. Right? Because you owe the $95,000 to the bank. What happens is this: you could apply for what is referred to as a short sale. Okay, you could apply for what is referred to as a short sale. Okay, and if you could prove a financial hardship, okay, and that's part of the that's part of it. You have to prove a financial hardship, and the bank has to approve you. So we're going to give a real nice big checkbox here. So the bank has to approve it. They have to give their seal of approval, okay? And what happens is this. So someone asked, Michael asked, so the bank buys the house. No. if you get approved for a short sale, here's what happens. They're allowing you as a homeowner to sell it for an approved amount. Maybe it's $80,000. Maybe a buyer comes in and you put it on the market, and the only buyer that comes in is willing to offer $70,000. Okay? So what happens is this. The bank will make the decision in regards to who gets to what amount they would approve in regards to the short sale. So the seller would put it on the market, so they'd put it on the MLS, maybe list it with a realtor, and basically what happens is this. Think of a short sale as a form of forgiveness. So you owe the $95,000, but because the market will only yield $80,000 or $70,000, and you could prove a financial hardship, what'll happen is this. The bank will approve it and allow you to sell it for that, satisfying that amount. So sometimes what happens is this. This is a much better option than to potentially go into a foreclosure scenario, stuff like that. Okay? So this is a really, really, really good option for a lot of people, and this happens a lot. So guys, I want to ask you, did that help you out? I know a couple of you asked about short sales, and of course, I want to try to satisfy you guys. Get into the chat box and make sure that I answer any questions, concerns, burning desires. But just let me know if that helped you out with short sales for those of you who asked about that. So someone said, so the bank absorbs the $15,000 that's left. Yeah, so basically what they're doing is they're allowing whatever the market will yield, okay? They will allow whatever the market will yield, okay, and that they approve. Remember, they have to approve this, okay? They have to approve that. So what happens is this. If they approve it, they're basically saying, that they're going to accept whatever it is. So another question that's coming in that's a great one, actually, I want to answer this one. Are short sales always cash only? No. Like, I've done many short sales where the person buying it is going to be, taking out a loan, a conventional FHA or VA loan, okay, right? So they're going to be taking out a loan, okay? So that is the difference there. And here's what I'm going to tell you guys. If you have questions on anything that has already gone through, that I've went over, feel free to rewind, watch this on replay, okay? Because I do have this on replay on the members only section, so you guys could watch this. So this is something that what I want to do is I want to make sure that we go over the secondary market a little bit. And Laura asked me, is the property advertised as a short sale? Laura, absolutely, probably going to be advertised as a short sale. And what happens is it'll say that you have to get bank approval, subject to bank approval, because it's not going to be necessarily the seller that's going to be making the decision. It's going to be the banks, okay? The bank that's making the decision on what they're willing to accept, okay? So that was a great question, okay? So let's keep moving. Let's keep grooving. Yeah, some of you guys are saying that in the chat box. You're like, we're moving and grooving. Yeah, you'll get used to my idiosyncrasies if this is your first time. I hope you're getting a lot of information tonight. So, what is the secondary finance market, okay? What is the secondary finance market, okay? And someone asked in the chat, because you must disclose everything, right, Stu? And the reason why the the short sale would be disclosed is not necessarily because of, and I think you might be kind of mixing it in with truth in lending. Not necessarily because of that, because you have to disclose everything, but because really the approval of the approval process is going to go through the bank. So this might be something that takes a little longer, okay, depending on the situation. So you really need to make sure that the buyer is being disclosed. It has the is aware of the fact of what might be taking so long for it to get approved and all that kind of stuff. And yes, because you have to disclose anything that would be pertinent that would be material to a deal. And one of the material facts would be that it's a short sale. That is definitely a material fact. So I wanted to make sure that I didn't get you mixed up, because we're talking about loans, we're talking about all the banks and stuff like that. So I didn't want you getting confused with any other terminology. That's why I kind of put it in there. Hey, we have to disclose this because it's a material fact, right? So, secondary market. Let's keep moving. Let's keep grooving. We have 3 folks on the secondary market. We got Fannie Mae. We got Ginnie Mae. We got Freddie Mac. Okay? And here's what I like to talk about with the secondary market. Okay? Some people say I can't remember Fannie, Freddie, or Ginnie. I'm going to try to help you out here. Okay? What happens is the secondary market is kind of what fuels the primary market. So imagine this. If I told you I had a candy store, right? I have a candy store. Yes, it always goes back to food with me. It always will. So I have a candy store, and I stock it with all Skittles, because that's what Stu's candy store would be about. It would be all Skittles, maybe some pralines. So I stock it with pralines and Skittles. Now what happens is all these customers rush into my store because, Stu, you're so awesome, you're so amazing, we love you, yay. They buy out all my Skittles and all my pralines. Now all I'm left with is money. All I'm left with is money, okay? And what happens is this. I then go to, I believe M&M Mars owns Skittles. So I would go to M&M Mars and go, hey, I need more Skittles to sell. I got all this money. And they would say, okay, here you go. And they'll wholesale it to me. I'll make some profit off of it, and I'll restock the stores, right? So everyone always understands a general retail transaction. So, Stu, what happens when your product is money? What happens when your product is money? So the bank's product, so the bank's Skittles is money. So what happens is, when they're done lending out money, they're left with these promissory notes, these mortgages, and they're like, okay, what do we do? There is no more money in the bank, and we have to do something with these. So what happens is these individuals, Fannie, Ginnie, Freddie, come in and they buy out these loans, okay? So they buy them out so that they service them, right? They buy them out so that they service them so that the banks could get restocked with their money Skittles, okay? So that's, in a very broad stroke of a pen, that's how this works, okay? So, let's keep moving. Let's keep grooving. Let's talk about them. Fannie Mae, okay? She is the big one on that secondary market, okay? Fannie Mae, okay, is the Federal National Mortgage Association. She is the largest purchaser on that secondary market. She's buying 1 out of every 10 mortgages or any of the notes that are on that secondary market. Some people said she's the mother of them all. Okay? What happens is this. You're going to have a situation where Fannie Mae is basically buying out and repackaging for investors. Okay, so people invest in Fannie Mae. Okay, she's basically repackaging these loans as like mortgage-backed securities so that investors could invest in it. And what happens is basically they're servicing the loans over time. Okay, so they're just sitting there and servicing the loans, and that's all well and good. So Fannie Mae, largest entity on the secondary market. Okay, so we got that. Fannie has the largest Fannie. That's how I always remembered it. So I don't know what you guys work with, but I hope that my candy store example, I hope that made you understand like what the secondary market kind of does and who's on that market. So let's keep moving. Let's keep grooving because I want to get through all 3 entities. Okay, all 3 entities. Okay. So, and I'll remind you, the money is not the mortgage. I will say this over and over and over again. Okay? Freddie Mac. Think of Freddie Mac as a smaller Fannie. And I actually kind of went over what hypothecation was. I put these Post-its up here because I was like, yeah, you know, let's make sure that we know what hypothecation is. So guys, as I take just a little sip, can we just type in the chat box, what is hypothecation? Oh, Andrew, and I don't know if I pronounced that correctly, you asked for jumbo loans. Yeah, that's actually a great thing. So, Fannie Mae, just so you know, I'm kind of going to go a little on a tangent. Fannie Mae actually does this, okay? They set the limits for each county in which they'll buy up to. Anything that exceeds that limit, so if it's a loan that exceeds the Fannie Mae purchase limit, it would be considered a jumbo or non-conforming loan. So thank you for keeping me honest on that. You guys, Stu Crew's awesome. I love you guys. I love that you keep me honest, okay? Because I have the attention span of a goldfish sometimes. So you guys keep me really on track, and I really appreciate this. So, hypothecation is using real property as collateral for repayment of a loan, right? We were talking about that earlier when we were talking about mortgages. So yeah, bang, bang, boogie. So what is an amortized loan? What is an amortized loan? And while you type in what an amortized loan is, let me also talk about Freddie Mac. So Freddie is a smaller Fannie. Now, don't get this confused. Some people actually say, oh, Fannie Mae doesn't buy FHA or VA loans. They only buy conventional and good loans. No, they buy everything. Like, Fannie Mae is going to buy everything. Freddie Mac is going to buy everything, okay? And what typically happens is, broad stroke of a pen, guys. Broad stroke of a pen. The Fannie Mae usually works with larger banks, commercial banks, okay? And smaller banks would be Freddie Mac, typically. But again, sometimes the streams cross on that one, okay? So, an amortized loan basically means someone said killing the loan slowly, right? We're eating away at it slowly. Amortized loan, okay? So, paying it down over time. So when it's fully amortized, there's nothing left at the end, right? So, let's go to the last one. Let's talk about Ginnie, or the Government National Mortgage Association. So Ginnie is not a purchaser on the secondary market. So some people always say, oh, she purchases stuff on the secondary market. What she does is she assists with and has special programs and incentives for Fannie Mae and Freddie Mac to purchase some, let's say, less desirable loans, right? Less desirable loans. And that's why the government entity's on there, so that, so that they would basically kind of say to Fannie, hey, that little loan over there that was given to a homeowner who maybe didn't have that great of credit or stuff like that, that Fannie Mae might be like, I don't really want that. Ginnie Mae has a lot of different programs. What they're going to do is they're going to assist with, so they're going to assist with some of those bad loans. So that is Ginnie Mae. And here's the thing, that is financing in my own little way, in my own little terms, okay, that kind of gives you a little bit of an idea. We kind of touched on a lot of different things, so I hope I cleared that up for you guys. Guys, put a thumbs up if I cleared up at least one thing for you tonight. If you say, hey, Stu, I learned one thing. And also, no, so Ginnie does not purchase loans. No. She sells pass-through certificates. That's the technical thing. She sells pass-through certificates, okay? And what happens is this. She assists because she has different, they don't buy. Ginnie doesn't buy. So a lot of you guys putting thumbs up here. I love the big Fannie, yeah. So here's what I want to do. I want to talk to you about a couple things before we wrap up. So let's talk about the schedule for the rest of the week. Tomorrow, you got in the morning or afternoon if you are not Pacific time, you got Vocab with Joe. And then you have Cynthia, the Cynthia crew. I don't know. Let's see what you guys come up with. But give her a nice warm welcome for me, okay? So tell her that, she's the next one that came on here. Like I said, you guys really warmed up to me. You made me feel so welcome, and I feel like part of the family now. So I really like, like working with you guys. So please make her feel warm and welcome. Then we have property ownership with Adrian, and then you guys know I like to wrap up the week, bring it on home with property transfer on Thursday, and then Facebook Friday. We are going to be doing this Friday. Now, the next thing I want to tell you guys is this, a little shameless plug. Remember, go to the More section and private tutoring. There, you see my beautiful smiling face. I book up really quickly, so schedule your session. Hit contact Stu if you would like to contact me, okay? I'd be more than happy to answer any questions, concerns, burning desires that you guys have. If you do not have any super duper questions, just hit schedule session, boom, and I will see you there, okay? So, someone said they'll be at Hershey Park for Facebook Friday. Go on a ride for me, get some extra cotton candy, enjoy yourself, don't worry about it, and you'll have yourself an awesome Facebook Saturday. So, guys, I'm out. I could stay with you all night, but I gotta get going. All right, so again, thank you guys for a great webinar, and I'm going to see you guys real soon.